Cryptocurrencies may now be classified as a commodity. That is according to a new bipartisan bill issued earlier this week. Speaking about this issue with us today is Ronald AngSiy. He is a senior vice president at Intellabridge. Welcome back to the show, Ronald.
Glad to be on, and I'm glad to talk about this bill. A lot of exciting stuff.
Yeah, a lot of exciting stuff indeed. We talked, you and I, last time about the Luna Terra crash, and we'll be revisiting that topic briefly today because part of this bill also touches on stablecoins and disclosures of stablecoins reserve-backed assets. Now, let's talk about the bill itself. So I'm just going to read a few paragraphs from an article by my Kitco news colleague, Anna Golubova. The headline here says, new sweeping crypto bill unveiled, and it classifies most digital assets as commodities. A bipartisan Senate duo unveiled the widely anticipated sweeping crypto regulation on Tuesday. The bill provides some much needed clarity for crypto markets and defines most digital assets as commodities, giving most of the oversight to the CFTC. Skipping ahead to the article, it says the biggest takeaway from the bill is that most cryptocurrencies, including Bitcoin and Ethereum, are defined as commodities which fall under the purview of the CFTC and not the SEC. So before we talk about investment implications, let's just step back and take a more philosophical approach to this issue. Do you think cryptocurrencies, let's just narrow it down to Bitcoin and Ethereum because cryptos is a very broad term, but Bitcoin and Ethereum, should they be classified as a commodity and not a security?
Exactly. You're 100% right that crypto is a very broad category. It's just like saying, what is technology, right? So, yeah, if you specifically want to say Bitcoin and Ethereum, I do believe in most contexts that those are classified as commodities. It depends on specifically, there are certain mechanisms of what you can do, and the mechanisms themselves can or cannot be securities, and it's a matter of how you want to define what a security is, right? Yeah. Like, is there a dividend issue? Dividends are typically issued by securities. So, there are certain mechanisms there, but on a broad level overview, I do agree with that assessment.
It just occurs to me that maybe there's a redefining of the terms here, because this is my view, and please correct me if you think I'm wrong or disagree with me, but a commodity is supposed to be anything that that has utility that's interchangeable with each other. In other words, let's say a barrel of oil. You have a barrel of oil, I have a barrel of crude oil, it comes from the same place, it does the exact same thing. An ounce of gold does the exact same thing anywhere in the world. It has the same properties, physical properties, and the same utility. Barley, wheat, so on and so forth. Bitcoin and Ethereum have different utilities, right?
So, I think when you get to the dividend issuing thing and you get to how that compares to staking, right? Staking is transactions and gas fee burning. Those are mechanisms, right? I think you could look at those and say, hey, oil, you use it to run a car, gas fee you use to process a transaction, and rewarding basically the validators once Ethereum moves to proof of stake. When you look at all of those things, I think you leave it to the legal experts, but I think something that's very easy for the normie audience to understand is the Howey test of what is a security. When you look into the Howey test, it's simply, do you invest money into something? Is it in a common enterprise that multiple people can participate in? Is there an expectation of profit from you putting money into something? And is the profit generated from the effort of others? So when you look at all of those things, a lot of cryptocurrencies typically use tokens in security-like fashion as they use it for fundraising elements, basically to fund operations, and they have elements that are kind of security-ish, like issuing, governance rewards and whatnot. But if you look at basically just Bitcoin and Ethereum, for a couple of reasons, I think placing them as commodities as of this very moment makes sense. Even the chairman of the SEC, Gary Gensler, has said that historically when Ethereum was first started, it kind of had properties of security. Yeah. But as cryptocurrencies become more decentralized like Ethereum, it now kind of has more properties of a commodity.
He did say in April, and I quote, that most cryptos or most crypto tokens are investment contracts under the Howey test. that could be interpreted as Gensler saying that or thinking that most cryptos should fall under the purview of the SEC, which is his domain.
Yeah, when it gets to that whole thing, I mean, it's just a giant turf battle between all the different departments and who has the power to regulate crypto, which itself is very broad. Like you have the CFTC, the SEC, the DOJ, the IRS, FinCEN, like all these different regulatory agencies. And yes, if you look at the SEC, I think though it's because it's the one people know about, right? It regulates stocks, and which is something that every normal human person does. The CFTC regulates like futures and commodities. Normal people don't really touch those things very often, right? The SEC was founded 50 years earlier than the CFTC and has a more than 5 times the annual budget. So clearly, you know, between all those factors, it's understandable why the normal person understands the SEC more than the CFTC.
Okay, we're going to talk about this new bill from both an investor standpoint and also a project creator standpoint. So let's start with investors first. Tax implications. Do we have to file our crypto capital gains taxes differently under this new bill? Do you know?
Yeah, so when you look at it, it talked about that $200 element. I think there's a lot of confusion around it. And my interpretation of this, if you look at it, is that basically any transaction where you have a capital gains of under 200 is not taxed. So let's say you bought Bitcoin at $1,000. And then now you want to buy a toy, an expensive Lego set for $1,200. You could spend that $1,200 worth of Bitcoin and not get taxed for it because the difference is only $200 in terms of the value of the Bitcoin at that time. So people who spend crypto on a daily basis are happy by this bill because it alleviates a lot of that whole Starbucks use case application.
Right.
There's actually the specific wording in the bill on page 6 over here, because no one actually reads these things, right?
Yeah,
it's a
we have to
69 page. Yeah, it's a 69 page bill. Nice. That says here specifically the amount of gain or loss excluded from gross income under subsection A with respect to disposition shall not exceed 200, which I interpret to be, again, I'm not a legal expert, but what I interpret to be is if you buy something for $1,200 and you originally have $1,000 worth of it, you're not taxed on that individual transaction, which gives a lot less math involved when you're buying stuff on a daily basis.
Okay. Yeah. I don't know if these same rules apply to physical commodities like oil trading and whatnot, but I would find it interesting to see that the CFTC is creating a new set of tax rules for cryptos and digital assets, which are now classified as a commodity, but still a commodity nonetheless. But something to look into. Now let's talk about, so tax implications. What about the regulatory power of the CFTC? People might be concerned now that the CFTC may have the authority or the power to ban certain cryptos or delist certain cryptos if they deem them to be not commodities, quote unquote.
Yeah.
Can they do that?
I think so even the SEC themselves has said they do not have the power to ban crypto, right? What these regulatory agencies do is that they look at laws enacted by Congress and they enforce those laws, right? So I think to take a very crass example over here is, but I think an effective example, like let's say you have laws on like, gun violence in the US, the Congress passes that law. And who is the sheriff of a town that basically enforces what that law looks like? Or maybe it's a law passed on a local level. So the CFTC and the SEC are debating whether to be the sheriff in town right now, right?
Yes.
And regardless of who is a sheriff in town, the SEC, because it regulates securities, which is what a lot of normal human beings interact with on a daily basis, like on Robinhood or Charles Schwab, they also have the ability to kind of regulate the gun store. So no matter who is the sheriff in town, the SEC can say, you cannot buy AR-15s over here, right? Mm-hmm. And so that itself is another form of limitation. So when you look at regulatory power, there's different context involved. Is it on the bill side where you have classifications of things and authority of things? Is it on the authority locally to enforce those acts? Is it on different mechanical functions like who has like making an ETF, which is something clearly is within the SEC purview of, right? So it just depends. No one can ban Bitcoin, right? But if you prevent all businesses from accepting Bitcoin at your local Starbucks, or you prevent anyone from swapping Bitcoin to $1, you effectively take it out of existence on a daily basis. So you're not banning Bitcoin, but you're kind of making it useless. So I think there's different layers of nuance when it comes to regulation.
I think the CFTC can, correct me if I'm wrong, but they can prevent or ban certain commodities from being listed on regulated exchanges. I specify and stress regulated exchanges. I'm not talking about if you and I opened some sort of DeFi exchange between the two of us.
Yeah. You're 100% right there. They can also prosecute against anything that has existed that isn't completely clear, but they can deem that it is not clear, the actions are not just, and they can work with the DOJ to prosecute a certain entity, right? There's a wide variety of things that you can go after, and you keep in mind that the CFTC isn't necessarily like, oh, because it's going to be listed as a commodity under the CFTC, all of a sudden it's like not as regulated, right? The CFTC just hasn't existed as long as the SEC, but it still has regulatory power to do similar things to the SEC, right? So I think that's just something to keep in mind. And they have expanded powers over the years, especially with the Dodd-Frank Act. But the way the regulatory and legal process works is that it's a creep, right? So the SEC has existed so long that they've crept their power up that now they can do so many things. The CFTC is newer, so they haven't power crept as much, but all these regulatory agencies grow and expand what they can do over time based on new precedents.
Okay. The SEC has a very robust framework on regulating public securities. Companies need to disclose their 10K, 10Q, intermittent reports. Those are heavily scrutinized and audited. Now, on the CFTC side, do project leads have to follow CFTC guidelines for disclosing any pre-mines, their code, who the founders are, any sort of information that I guess the SEC may want for, let's say, a publicly traded stock?
So that is not something that the CFTC has ever clearly defined, because like that's kind of like step 7. Well, people are focused on step 1 right now of who even has the legislation to do that. So if it does happen where the CFTC is kind of crowned as the regulating entity, I'm sure a lot of that stuff will come down the line. And if you look at regulated entities, they're preemptively doing that, right? Like if you look at analogously the art market, there is no explicit regulation right now, not much explicit regulation around KYC, AML sort of things like identity checking and make sure you're not money laundering. But a lot of art houses see that happening. They see regulations in Europe happening, and in the US, they're like, oh, we're going to preemptively require anyone who buys artwork over $100,000 to give us their passport or whatever, right? So we know who they are. So that is something that the private sector is starting to do more. And if we take a step back, this is why it's so important to have regulation, because you and me, we can just go on DeFi and just DeFi ourselves, right? And then, if something comes along, we just modify our taxes or whatnot. If you're like the California Teachers Pension Fund and you're putting hundreds of millions of dollars into something, you're not going to do something unless you're 100% sure it is completely legal to do. Because if not, even if you have good intentions, it can lead to like lawsuit city, right? So that is why whether it's a SEC or CFTC and what rules are in place, all of that is important to get larger bodies of money participating in these markets. And that is why, it's about figuring that step out first, because then it'll lead to the answering of questions like what you just asked, which is something that's like not even on the radar yet for an entity like a CFTC.
people talk about regulations to prevent projects from getting rug pulled or investors losing money from, scams like Squid Game coin or whatever have you. But think about it. There's nothing really the regulators could do except issue guidelines, right? There's nothing stopping, let's say, a VC investor from losing money because his startup just rug pulled him, so to speak. Or there's nothing stopping from a penny stock company from going bankrupt and the investors losing all their money. So walk me through this. Can regulators actually prevent or help investors with the smaller altcoin the markets and help them make more informed decisions? Yeah.
I think there are certainly things that they can help with, right? Like communication and what you're allowed to communicate. There's a reason why everyone online says this is not financial advice, right? And it's because there's all this regulation around what you can promote, what you cannot promote, what can individual people participate in, what are net worth requirements, participate in certain assets. And we can have a long-winded back and forth debate on what is permissible and what should not be permissible. But there is certainly an opportunity to create a more informed market by having certain mechanisms. Like you could have some right now. You could say, oh, if you buy this, you get 20% of all the revenue generated from any future sale that I make, and here are the future financial projections I'm going to make. There's a reason why, you cannot list forward-looking public projections when you're doing an IPO process. It's because you can just say things are going to the moon, right? And so you get 20% of all revenue from that. And with this bill over here, explicitly, it talks about issuing dividends or, revenue sharing activities as something that would then make it a security and give you all that regulation, right? So you can't have like some, charlatan come in and just espouse all the ways you're going to make all this money, right? With that said, that is one half of the equation. The other half of the equation is just cultural norms. Back in the day when you're the internet and people were saying, hey, a Nigerian prince needs some money, please send it to him. He'll give you a lot more in return. People actually fell for that like 15 years ago.
Laugh, yeah.
Nowadays, you hear people say that, you're like, clearly, like, that's terrible. Now, the phishing attacks have gone better, right? But there's a cultural norm that has come there when it comes to like NFT projects that promise a very glamorous roadmap. In the future, it might be such that if there's a crypto project led by an anonymous team, you're like, anonymous team, I'm out. That might be a cultural norm.
That was my next point. Are NFTs commodities now?
NFTs are not explicitly covered in this bill. But when you, regardless of whether something is an NFT or a token or whatever, just look at the properties it possesses, right? I think a lot of NFTs like have an exciting roadmap of gamification or making something interactive and giving something to the community and putting them in groups. Like that's fine. And it depends on your ability to discern whether how true or not true that roadmap is, right?
Yes.
But the moment it starts saying we're going to start giving you 20% of all the revenue from all resale transactions, that's when you say, all right, this is a security. So it depends, regardless of the title of it, forget the title of something. Look at the mechanisms of what it has. And that gives you a much more clear view. Like we have NFTs, I think Ethereum, they talked about kind of soul-bound tokens. And there's going to be more jargon coming out in the coming years, right? But outside of that, things like the Howey test, I think is universal to say, do you put dollars into something hoping that your dollars become more dollars in the future, right? Like that's an investment. And then from there, there's other series of questions until those other series of common sense questions leads into a natural answer of whether something is a security or not.
Yeah, for sure. All right. So it rests on the assumption that commodities are not things that you put dollars in hoping that you get more dollars out of the future. Not all commodities
it's
meant
more
for that
complicated
purpose.
than that. Like oil, oil has something like those mechanisms, but oil is not necessarily considered the same way you would treat other assets, right? So it depends. Or there's a series of things into it. And it'll be interesting to see, because the thing is, crypto can be so many things. It's like all the above, right? Because of its properties. And that's what makes it so hard to regulate, because you get 5 different people look at it and say, here's 5 completely different use cases for it. So that's why so many different regulatory departments can look at crypto and say, it does this, and because it does this, we think we should regulate it.
Just out of curiosity,
it's something that needs to be clarified.
Just out of curiosity, I'm going to close on stablecoins, but just out of curiosity, for the CFTC, do they have the jurisdiction or the authority to tell futures traders to stop messing around with the price of barley or wheat or grains? You know, because that really directly impacts the prices of food and would impact a lot of people. Let's say you've got a bunch of traders from a bank or a number of financial institutions all cornering a single commodity or soft ags market, right? I mean, wouldn't that need to be regulated? Would there be some sort of control on the number of trades you can make? Or where I'm going with this is the CFTC, do they have a mandate to sort of look out for, I guess, the well-being of the people when it comes to certain commodities that affect everybody? And if so, can that power be translated to cryptos? Because they could say, hey, guys, stop speculating on Bitcoin because of XYZ reasons, right?
So the CFTC does regulate the futures market for agriculture. So you're right, that it is something that is within there. And they do that to minimize dramatic price fluctuations.
Exactly.
Like
we wouldn't want dramatic price fluctuations in food. But now they can probably think, let's do that for Bitcoin, right?
So, like, for example, a major flood could cause corn supplies to suddenly fall, right? Because all the foreign corn is destroyed. If not for the futures market, a lower corn yield means corn prices skyrocket to the moon for cereal makers, and that sucks. But the ability for the futures market to hedge against this price change helps farmers and food companies plan for these expenses and keep prices more stable. So, like, you're right. It's more complicated because it involves the futures market a lot of these times, and that's something outside of what normal people really see and interact with in real life. But the very, very high level answer is yes, you're right.
Okay. Let's keep tabs on what they're doing with the crypto market. Stablecoins, finally, I'm going to go back to the article. It says here, the new bill also sets out rules for stablecoins, digital assets pegged to traditional fiat currencies like the US dollar. One of the conditions is that stablecoin issuers would be asked to keep high quality liquid assets equal to the amount of all outstanding stablecoins. They would also be required to disclose the assets backing their tokens publicly. This sounds like a direct target or attack on what happened with the UST Luna scenario case. I'm just wondering whether or not this means the death of algo coins, right? Because no more algo coins.
I think it's interesting how the narrative shift, because this bill was in the works for a while, and for a long period of time that people said this bill attacked Tether, right? And then UST collapsed, and now the narrative switch of this attacks the UST.
Yes.
When it comes to this, I think we take a step back of whether it's algo coins or Tether or whatnot. Like, again, reading the bill itself, I think more people should read these things and get the insights from there. Like page 44, I want to read off the 7 examples of what's considered like cash and cash equivalents, right? I'm not sure we have enough time for all 7, but I'll just try to breeze through. It's like one of them, U.S. coins and currency. Okay, that's very regulated. 2, demand deposits at depository institutions. Oh, Bank of America, that's very regulated. 3, balances held at a Federal Reserve Bank. Very regulated. 4, foreign withdrawable reserves. This consistent with any foreign unit of account that is denominator pegged. This is where it can get maybe a little squishy. Depends on getting legal experts to look at that. 5, a security that is issued by the Department of Treasury. Very regulated. 6, reserve or purchase agreement, which is similar to number 5. 7, any other high quality liquid asset determined to be consistent with safe and sound banking practices. Very regulated. So if you're like, okay, a stable coin has to be 100% regulated by either cash or one of these 7
cash
other criteria that's also very regulated. Like, that is a more that's less of a narrative against UST and more of a narrative against, no matter what a stable coin is, we need to see everything that is going on under the hood, which it's more of an opening the gateway to JP Morgan coin than I think it is created as an attack on a stable coin.
I think
with that said, it does impact algo stable coins, which I think is unfortunate because in real life, when you deposit $1,000 in Chase Bank, they lend out $10,000 fractional reserve lending. So stablecoins inherently don't have, if it is required to be one-to-one collateral backed without FDIC insurance, it does not, it is inherently at a capital efficiency disadvantage to traditional banks
Yes.
that can do fractional reserve lending.
Yes.
So it kind of screws over a lot of the applications in DeFi. And I think that is something that needs to be more closely looked at. But that's a broader question. That is certainly a broader question. That might require its own dedicated session.
Yeah, well, we'll come back to that. I mean, I just spoke to Tether not too long ago, and like they have $72 billion in circulation, but they don't have $7 billion of cash per se. They have cash and cash equivalents stored somewhere. But it's not, people need to understand the collateral is not always cash. It's like you listed, cash and cash equivalents. Some are rather opaque in its regulation, depending on what these things are. So finally going back to my point, algo stablecoins, what do they need to do now to survive?
I think there's so many markets outside of the US for algo stablecoins to be permeable in. And even within the US decentralized finance, algo stablecoins can still exist. The key is, where do you withdraw that to fiat land? And I think that is a larger outstanding question. But it's certainly possible, and I would argue needed for algo stablecoins to be existent. Because of what that represents in terms of decentralized finance. I'm not sure if I said this in our previous interview. What's the point of decentralized finance if it runs through a centralized stablecoin? Like, why don't you just have all of DeFi just run through Amazon then? Or Amazon run through its own exchanges, right? Because DeFi inherently structurally is more inefficient than a centralized server with centralized machines that are running things, right? So that's certainly a broader question, but a lot of people have their net worth and they're billionaires, but overwhelmingly their net worth is in stocks, or it is in like a trust fund that they can't access directly. There's certain levels of utility, but even if you can never withdraw an algo stablecoin and buy something at Starbucks, there's still a lot of utility that can be had from algo stablecoins. So I don't want to be sensationalist and say it's dead. And always regulations can be revisited in several years down the line, especially based on who's the political leaders in charge and what the voters want at any given point of time. So this is a snapshot in time, and this is what the world looks like. But as we all know in crypto, the world can change very quickly.
Final question, I'll let you go, Ronald. Price, does this bill have broader implications for what people call the crypto winter that we're seeing right now, where that's setting in? You've already talked about how it affects stablecoins and DeFi at large. A lot of applications could be harmed indirectly or directly, but let's just take Bitcoin, for example. Do you think this bill has any impact whatsoever on the larger scale of Bitcoin's price history? Just today, for example.
Yeah. Well, first of all, this bill doesn't honestly mean anything because midterm elections are coming up. Nothing's going to happen until midterm elections. And if you look at the politics of this, bipartisan bill can mean like one senator on like one other side of the aisle agrees to like as a co-sponsor the bill, and all of a sudden it's bipartisan, right? It doesn't. It's a very squishy term. Although the two people behind this bill are actually very prominent figures within their respective parties, so that's good. But just in general, that's kind of like a squishy term. Yeah. Two is there's going to be a broader war for the soul of crypto. It's really unfortunate because crypto should be a bipartisan issue, right? But there are very, very few bipartisan issues in Congress. Everyone typically wants to take an issue and make it its own thing.
Right.
So we will see who is the party that becomes a champion of crypto, that single issue voters decide to vote for.
What do you think? Let's make a speculation for us before you go.
I mean, crypto is inherently libertarian by its origin, and the Libertarian Party is a subsection under the Republican Party. So I think it makes sense, which is why a lot of them have saw it, because a lot of the typically progressives or liberals are more for regulation of things.
Yes.
The whole point of crypto is it decentralizes and make things autonomous and free. With that said, I hope both parties support crypto.
Okay. We got to go, but Ronald, excellent thoughts. Thank you for your insights on the crypto markets and what this bill means for investors. We'll follow up with you again next time. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more here on Kitco, and don't forget to subscribe to our YouTube channel.